Hello and welcome. Moss Adams is pleased that you've joined us for today's session, Trends and Developments Impacting the Energy Industry. Before we begin, I'm going to play a brief video.
Welcome, and thank you for viewing our webcast series. Before we begin, please keep the following in mind. You can customize how you view our presentation and interact with the presenter. For better viewing, close all other applications and turn up your speaker volume. You can adjust window size and placement or enter full screen mode using the controls at the top right of the window or dragging the bottom right-hand corner to resize. At the bottom of your screen, you'll see a series of icons that relate to a different aspect of our session. You can download a PDF of today's slides from the Slide Deck and Handouts widget. You can ask questions by typing in the Q&A window and clicking Submit. We'll do our best to answer all questions or follow up via email. If you experience technical difficulty, refresh your browser by hitting the F5 key. This presentation is not legal, investment, or accounting advice. We encourage you to seek the counsel of a professional service provider to apply this content to your specific circumstances.
All right, and now I would like to turn it over to Julie Desimone, Partner and National Practice Leader of Power and Utilities, as well as National Practice Leader of Renewable Energy here at Moss Adams. Julie, the floor is yours.
Thank you, Amy. Thank you for everybody being here today. Once again, my name is Julie Desimone. I am really just here to introduce our wonderful presenters today and be the moderator of the event. So I'll be the one checking the Q&A. So please go ahead and put all your questions into your Q&A. But I'm going to actually let our presenters today introduce themselves. We're here today to chat about the energy industry and the hot topics and what's hitting the industry right now. And at first, I would like to introduce George. George, can you introduce yourself and answer a key question for us today about what is your opinion on a dynamic trend that's hitting the energy industry in today's environment?
Hi, Julie. Thanks for the intro. Hi, everyone. I'm George Yong. I'm a partner and head of the infrastructure strategy here at Aura Partners. By way of introduction, Aura Partners is a private equity and infrastructure firm that makes investments across the industrial decarbonization landscape. We think our differentiation is there's quite a lot of capital coming into energy transition and renewables, but a lot of it, most of it, I should say, is focused on electrification and what we call the greening of the electron. At our partners, our focus is all about industry, hard to decarbonize industries, and really the greening of the molecules. I've been here since the start of 2022, and prior to that, I spent a decade at ArcLight Capital, which is an energy infrastructure fund more focused in the conventional space. So, hopefully the perspective I can bring to this panel today is both the combination of my legacy coming from, the old world of energy to now, very much a focus on the future of low carbon energy. In terms of energy trends for 23, I would say the Russia-Ukraine crisis has certainly brought back the concept of energy security. And, I would point out that one of the unheralded dynamics that it's created is that there is more so than ever an acknowledgement across the industry and that both kind of the old energy world and the emerging energy world are going to be critical to all developed economies, including the U.S. So whereas over the last decade or several decades, it's been a bit of a pendulum swing, right? Of you're either old energy or you're new energy, or there's more support for hydrocarbons versus less. I actually feel like for the first time, there is a very strong push toward continuing conventional production of energy in a more responsible manner, while also bringing significant investment, regulatory support, and legislative support to bringing, low carbon energy, and all with a view to energy security.
Perfect. Thank you so much, George. Welcome to the presentation. Blair, you're next.
Sure. Hey, everyone. My name is Blair Barlow. I'm a director at Lime Rock New Energy. We are a private equity fund investing growth capital in the energy transition. And I guess just by way of background, for those of you who do not know Lime Rock on the call, the broader Lime Rock organization has been around for 25 years. We have a long history of investing in the energy space, but the vast majority of that time has been in the traditional energy sector, mainly in upstream oil and gas. But the catalyst for us going out and raising an energy transition fund really happened in 2015, when one of the original partners, Mark McCall, took a sabbatical from his role as a private investor and went down to Washington and ran what is called the Loan Programs Office, which I'm sure most of you listening to this call have heard Jigar Shah speak in one format or another over the past couple of years. And so Mark McCall held that seat at the DOE for a couple of years at the end of the Obama administration. And I think what that really did is it really gave him a much more, unique perspective and advanced view on what was happening in and around the energy transition at that time. And so when he came back to Lime Rock in 2017, he sat down with the other partners and they put together a team and a strategy around raising a fund in the energy transition. And so what we are focused on at Lime Rock New Energy, it's quite a bit different than what ARA is doing, that we're more focused on the ecosystems. We're focused on the companies that are providing the products and the services in and around all the big projects and infrastructure that's getting invested in. And the three verticals that we are focused on are, those businesses that are providing products and services to the build out of, facilitate the build out of renewable power and storage, the electrification and decarbonization of transportation, and then energy efficiency, which is a pretty broad bucket, but think about it more in the industrial and the built environment. And in terms of trends that we're thinking about this year, I think the one trend that we're watching closely, and I think it's going to be a dynamic one this year, is just how aggressively companies in this space, I'm speaking specifically about the energy transition, continue to push this agenda of growth. And you put that against a situation where we might see a throttling back a little bit this year of companies operating in this space to preserve capital in what continues to be, a really uncertain environment, both in the broader markets and in the capital markets. And, it's top of mind for us because we just came out of a budgeting cycle with our portfolio companies. And I suspect a lot of boards around the country and in this industry and executives that are operating companies in this industry are really just trying to find that right balance, right? So they're trying to strike the right balance between what is, a cautious stance in regards to their capital allocation strategies, just given the headwinds that we saw in the second half of last year, which have largely persisted into this year, versus, I think what we all see is, growth on the horizon, and whether you take that capital invested today to make sure that you are in an optimal position to capture what I think we all think is a high rate of growth and an opportunity for value creation in a couple of years. And so, I think it's a really complicated question. I think we saw a lot of issues in the broader economy, in the second half of 2022, which did slow things down considerably in certain sectors of the areas that we're investing in. But then on the flip side, the energy transition landscape more broadly and globally grew by over 30% last year. Bloomberg put out a figure that $1.1 trillion got invested in this space last year. So even in the face of all those headwinds, and I think we'll talk about it later, but inflation, supply chain, general macro slowdown, this industry still grew pretty rapidly last year, which, really kind of makes you second guess some of your capital allocation strategies and which segments of this market you want to be exposed to. And again, I know we're going to talk about this in a little bit, but you put the sort of certainty around what is now been underpinned by the Inflation Reduction Act in both accelerating the more mature ends of the market, be it renewable power and the electrification of transportation, but then also providing that catalyst for the industrial supply chain in areas like clean hydrogen and CCS and others. And so, yeah, I think it's going to be a very interesting year. It's something we're going to be debating heavily at our firm and with our portfolio companies. And it's ultimately going to be sector and company specific in terms of what pace of growth or what pace of investment people put forth this year. But I think it's something that we should all be mindful of, and it's going to be interesting to see how it plays out in 2023.
Absolutely. Thank you, Blair, so much. Jimmie, I'm going to turn it over to you.
Okay. Hi, I'm Jimmie Williams. I'm a partner with Moss Adams. I'm our consulting energy industry group leader, as well as transaction advisory services partner, and really work around kind of the energy, a number of energy transactions, everything from upstream oil and gas to oilfield services to renewables, traditional generation and kind of the energy transition space. We do primarily financial diligence, financial and tax diligence, and then just work through various transactions. So I think if you kind of look at the trends kind of coming into 23, which will be interesting to play out, is with the passage of the Inflation Reduction Act, with the IRA, I think we haven't yet fully seen kind of the impacts of that. So I think in the renewable space, it's kind of yet to be seen all the impacts of that new bill and the incentives that are around the IRA, which I know we're going to talk about a lot more later. And then I think, as others mentioned, it's just the continuing development of kind of what's going to be happening in the energy transition space, and the amount of money that's going to be having to be spent there in the energy transition space to, on the infrastructure and all the various things around that transition. So I think those will be the kind of the interesting themes, and and hopefully kind of the M&A markets will continue to be fairly active as they have been over the past couple of years.
Okay. Thank you, Jimmie. Brian.
Hey, good afternoon, everybody. I'm Brian Graff. I'm the Vice President of Finance at HEQ Deepwater. Prior to that, I was at Quantum Energy Partners, and prior to that, I was in the Energy Investment Banking Group at Morgan Stanley. For those of you that don't know, HEQ Deepwater is a partnership between Quantum Energy Partners and certain members of Houston Energy that is acquiring positions and non-operated interests on the upstream and infrastructure side in the Deepwater Gulf of Mexico. Houston Energy is a legacy industry leader in terms of deepwater exploration, with a success rate of about 80%, which is well above the industry average. And to give you a sense of the scale of what that's produced production-wise over the last decade on their prospects has been over 235 gross million barrels of oil equivalent, with an additional 700 million barrels of oil and 1.1 TCF of reserves. And so they've really been a key generator for producing these new properties, new developments in the Deepwater. In 2021, we formed the partnership with the idea that we would be able to utilize the technical skill set and geologic expertise from Houston Energy at a time where capital was scarce and also service costs were at cyclical lows to enter into projects at the development stage. One of the key themes I'd point out for 2023, especially on the upstream side, is just there are some headwinds for us to be able to grow production maybe as quickly as had been seen in the past. The first point on that would be capital efficiency. Inflation has really impacted the cost side over the last year and is expected to be in 2023 further some. In 2022, we saw about a 15 to 20% increase in costs and expecting another 20% in 2023. All the while, we're seeing less productivity from new drill wells. So we're going to have to spend more money to get less production. And at the same time, you've seen less capital come into the space and people flee. But also public companies have been kind of hamstrung in terms of reinvestment rates. In 2015 to 2017, you went through a period where most companies were outspending cash flow. And then we went through a period of living within cash flow where it was close to 100%. And now folks have been reinvesting at a rate in the high 30%. And so if companies still are going to be held to that standard of returning cash to shareholders and not spending as much on the CapEx side, now you're in a dynamic where, the world's energy needs are growing. We've underinvested in hydrocarbons over the last couple of years, but we're going to have less capital that's less efficient to growing production. So it'll be interesting to see how that plays out.
Perfect. Thank you, Brian. Moving on to Shane. Now, I will say, if you won't be able to see Shane, we have some camera difficulties with Shane. But if you do want to see him, look to your left of your screen. You'll see a great picture of him. So Shane.
Hi, all. This is Shane Easter. I work with the Wells Fargo Renewable Energy and Environmental Finance team. And for those that do renewable project finance, it's tax equity. So I've been doing that for almost 9 years now with the team, leading wind, solar, battery transactions. And we're certainly looking into the new asset classes as well, CCS, clean hydrogen, standalone storage, transferability that are all afforded by the IRA, which I know we're going to dive into later. I think in terms of broad industry trends and electricity, which is where we primarily focus, that I would sort of highlight before we dive in is just, first off, that I would echo some of the comments made by Jimmie that we're sort of in the gestation period still for the IRA. I think everybody's gearing up to make the most of this kind of all of the above, energy transition, clean energy transition approach that's afforded by the IRA. So I think everybody's kind of putting the infrastructure in place, if you will, this year to really accelerate the pace of capital deployment going forward. And then the other thing I just wanted to highlight is the ongoing headwinds. I mean, last year we saw a significant amount of solar energy pipeline that was pushed out by the ongoing trade war and new threat of new tariffs. And I think those have been revived as of last week by a bipartisan group and the Congressional Review Act. And so that's another potential headwind for the growth and for the clean energy transition this year.
Great. Thank you, Shane. Matt, why don't you finish it up on introductions, answering the first topic question?
Thanks, Julie. Good afternoon. My name is Matt Kaden. I'm a managing director in the Moss Adams Consulting Group. I focus on energy and tax. Before Moss Adams, I was at a large investor-owned utility. It's actually the largest generator of wind and solar energy in the world. Specialized in M&A tax and the structuring of tax-advantaged investments. So actually, I've worked a little bit with Shane in that area, particularly in energy transition and decarbonization. So, talking about things like equity investments that would be flip partnerships, leasing transactions like sale leasebacks, lease pass-throughs, inverted lease structures, and now we're getting into, obviously, the structuring, the purchase and sale of transferable tax credits, which are sort of, it's a big piece of the capital stack on these, on a lot of these renewable projects, a lot of the decarbonization projects as well, and sort of looking at new structures all the time as we sort of advise everyone from sort of early stage developers and clean tech technology startups to large utilities. For 2023, I was going to sort of be a little pessimistic and say uncertain. Uncertainty would be a trend, but I think flip side of that, I'm going to say innovation. I think obviously the IRA, for obvious reasons, $370 billion and change is going to spur a lot of innovation on the technology side. And so right now we're seeing this is the time of the engineers, right? This is the time when people are coming with their ideas, raising equity capital, startup capital. It's their time. But sort of the other piece of that is the financing technology that has to go along with it. New financing structures, new sort of means of repayment, new economics that are coming with these new technologies, with the new contracts that come with them, and the new tax credit sort of transferability structures. So, it's going to be really interesting to see how these companies that are very excited and have a lot of great ideas and potential products, how they're able to monetize some of this and get these projects built in a way that sort of makes sense and sort of lines up with their initial projections. And I think that's going to be where the rubber hits the road, and we see a lot of creativity and new ideas in 2023.
Perfect. So I'm going to ask Matt to stay on the speaker. So, as we keep mentioning the IRA, which is the Inflation Reduction Act, maybe it should better be termed for the energy industry as the Infrastructure Act, as it's going to populate a lot of funds coming towards the energy industry. I have asked Matt to try to put the IRA in a 5 to 10 minute nutshell, which good luck with that, Matt, because it's quite an extensive act. But where do you see it hitting the energy industry? And I'm going to ask our other presenters to give their thoughts. So we've got a good chunk of time just to delve into the IRA.
Well, so I think you can sum it up in one sentence, right? It's enacted in August of last year to reduce inflation. No, I'm just kidding. I'm not sure it's going to do that completely, but I think it is intended to accelerate the energy transition. It's increasing the incentives, obviously, to develop electrification, electric transportation, decarbonization technologies, as well. And a big piece of it, this is kind of the Manchin influence, is the sort of domestic supply chain, right? And this also gets into sort of energy security, which is perhaps a trend given everybody shooting up our transmission stations. But I think we have. Clearly the domestic supply chain is big. The electrification, transportation, and industrial transition to cleaner fuels is sort of the idea behind it. In broad strokes, I think you can break it into maybe two major categories of incentives, and sort of one is investment tax credits, which you receive that benefit, which is in the form of a tax credit as a percentage of the amount that you invest into a particular facility. It could be a wind facility, it could be a battery storage facility, it could be a manufacturing plant that builds batteries or manufactures solar panels, and you get that you get the credit based on your investment amount. The other type of credits that are predominant sort of in this legislation are production tax credits. And so that would be things that are based on what the facility generates or sells. So for example, production tax credits for solar or wind generation, they take a particular dollar amount and you multiply it by the generation that you put onto the grid, and you get your tax credit that way. Similarly, if you are part of this domestic supply chain I was mentioning, you've built a plant, you can also, instead of taking the investment tax credit on that, you can also take a production tax credit, which would multiply whatever you're selling, solar panels, for example, multiply that equipment by a particular dollar rate to calculate your credit. So, and a lot of these credits have that optionality where you can sort of decide and model out, hey, do I want to take an investment tax credit up front, which, to my point about financing, maybe gives your investors some payback, your investors that are in it for the tax benefits, maybe they get some immediate payback, or do you want to sort of go for a long-term production tax credit, which can be 10 to 12 years, sort of do that annually. Could be more lucrative on a nominal basis, but perhaps the sort of return is not as immediate, and so perhaps is not as beneficial to financing counterparties. So those are the two general categories of things that are in here. And there's also grants, direct grants and below market loans that are available from Jigar Shah, Department of Energy, and various other government agencies, which are part of this as well, part of that $370 billion number. But, just broadly, you have basically an expansion of a group of credits, and then you have some new credits as well. So some of the new credits are, for example, there's a nuclear energy production credit. There's a clean hydrogen production tax credit. There's, commercial vehicle tax credits and various things around the transportation infrastructure. So those are new credits. And then, we also have an expansion and extension of existing credits. So we have a number of these credits that people have been using for a number of years, the solar and wind and hydro and biomass type credits. Those are now, we're going to be phased out over a period of time, and now they're at their full value through at least 2033. So, I think that provides significant ability for long-term capital planning and investment, that sort of extension. And then there are other credits that are also expanded. So a few years ago, they enacted the carbon capture and sequestration credits, Section 45Q. They thought that would be enough to sort of spur some investment. It really wasn't, it turns out. And so now they've really supercharged those credits by a factor of about 2.5 to 3x. And now we're seeing a ton of those, obviously, sort of come out of the woodwork. So you have that sort of one category that's new, the one category that's expanded. I think, what are the impacts of that? Like I mentioned, I think the first one is, hey, you've got the ability now to set your long-term capital plan. If you're a utility, if you're a developer, if you're in the energy market in any way, you're able to sort of set that plan. As one example, there's a lot of old wind farms and solar farms in the United States that are in excellent locations. They have a good wind resource, or they have a good solar resource. Now with this extended credit period, you could actually make some investments into those facilities and renew the tax credit life. And so you get another 10 years of PTC or a new ITC if you're able to comply with the so-called repower provision. So there are a lot of opportunities like that come from the extension and expansion through 2033. I think another big one that we're seeing is people need help in deciding, hey, what is my credit here? Because the IRA makes the credit calculation significantly more complicated, and they make you jump through a bunch of hoops to get those credits. Before, you could just sort of prove out your investment, simplifying a little bit, but prove out your investment for the ITC, give the IRS a meter readout of your electricity generation to get the PTC. Now you have to meet so-called prevailing wage and apprenticeship requirements. You have to pay the employees in accordance with the Department of Labor standards. You have to have a certain amount of apprentices on site. And that applies to your contractors and subcontractors, anyone that's working on a project. And if you don't do that, they have the ability to haircut that credit amount by 80%. So that's a huge value driver and complexity that the IRA has added. The other thing is they've added significant bonus or enhancements on top of the full credit amount. So for example, if you have a 30% ITC, which is typical, if you're able to meet all those prevailing wage and apprenticeship requirements, if you use equipment that satisfies the domestic content requirements, it's made with a certain percentage of manufacturing components in the United States, you'd be eligible for a 40% investment tax credit. And there's similar credit enhancements for building in energy communities and building in for smaller facilities for low-income areas and tribal lands. So all of that requires a lot of thought and modeling and scenario planning, and we're seeing a lot of that come across as well. Again, there's been an expansion of new technologies, biogas, microgrid controllers. People are pouring a lot of R&D and capital into that currently. Again, new technologies, they may work, but sort of what is the economics? How does it get financed? Is there a tax equity market for it? How do you monetize the tax benefits? All this stuff is in a time of a little bit of uncertainty, as mentioned. And then the other thing I think is the direct pay and transferability. Before, to build these credits, to build these projects, you imagine someone that's heavily investing CapEx. They have a lot of depreciation, tax depreciation. There's bonus depreciation that allows you to fully expense your CapEx. And so that sort of creates a lack of taxable income for the people that are building and owning these projects. And so before, they kind of had to partner in these equity transactions called tax equity transactions, where you sort of have an equity investor and they take the tax credits and you as the developer or holder get the cash, those are still going to be predominant structures because of the way they allow you to monetize the depreciation. But there's also this alternative now to sell those credits to anybody. Not just the sophisticated financial institutions that do the tax equity, but really any corporate investor, potentially individuals, although that would require IRS guidance. But there's sort of this break the glass option for folks who are developing these projects. It may come with a discount. It may sort of depend on your ability to guarantee those credits with a strong balance sheet. But there is this option, this sort of option of last resort that I think is going to allow projects to get built that would not get built if they had to rely solely on the sort of traditional tax equity market. So I guess one question to the group would be, what do you see in all of your various areas of expertise as being the most significant impacts from the IRA in 2023? Start with Shane.
Yeah, I think the most significant impact is stability, a stable framework of incentives for the clean energy transition, right? I mean, we've seen, and Matt certainly in his past life at the largest wind developer in the country has seen the boom-bust cycles associated with the phase-in, phase-out nature of these credits and how much ramp-up, ramp-down of the industry that's caused over the past decade or so. And so I think the biggest impact overall that we'll see is just a more stable framework that everyone can plan around and put a growth plan around. So I think that's very, very favorable. And then I think that, the sexiest part of the IRA, at least for what I do day to day in terms of helping clients to monetize the tax credits associated with these clean energy assets, is transferability, right? And so I think right now you've seen a number of platforms pop up that are seeking to be brokers of the credits and connect buyers with sellers of those credits and make a spread on that, as well as lots of investors thinking about where they want to play. Do they want to be buyers of credits? Do they want to be sellers of credits? And what are all the ESG implications of that choice when you're just talking about buying and selling a credit versus actually being an investor in a partnership to realize those credits up front. So those are a couple of the larger impacts I would point out.
Great. Blair, do you want to give us your thoughts?
Yeah, I mean, I think I agree with Shane. I mean, certainty and stability gives companies confidence to invest, right? And so, I think, can't remember who said it, but, somebody said it was early days and there's not a lot, to point to that is sort of tangible in this sector so far. But, from our lens, and we have I just thought I'd give an example. We have a portfolio company, Electric Power Engineers, which is an Austin-based power systems engineering consulting firm. And they work with a lot of developers and utilities. And I kind of asked them, what have you seen change since the passage of the IRA? And I think they said three things. One, there is a sort of renewed confidence from the developer and utility community that their projects will be economic. And so there's been sort of reinvigoration of planning and development from those parties. And I think that is after a somewhat difficult year in 2022. So they have noticed sort of a shift in mentality from that group of customers. Two, they are seeing new entrants come to the market, which I think is notable. They are seeing a lot more European companies, including some large European entities, starting to focus more on the U.S. market than they have in the past, because I think they are being incentivized by this versus the attractiveness of what's happening in their home markets. And then three, they are seeing an increased momentum on some of the new technologies that are in and around the power and grid space. So they have seen, more, I guess, a pickup in their consulting work on green hydrogen, fleet electrification, large-scale industrial electrification, port electrification, offshore wind, they have seen, some more activity in this space. So, I think another thing that they will see, and something we think hard about of what the IRA is going to bring, obviously it's going to bring a lot more generation online in the next few years. I've seen estimates anywhere up to 45 to 50 gigawatts of utility scale solar installed starting 27, 28, and that's up from, I think, low double digits, teens in 2022. So a pretty massive scaling of generation, at least expected in this industry. And I think what we're going to see from a lot of the generation that comes online is just an increased complexity in how all of this is going to get integrated into the grid and how they're going to get those electrons to market. So those are some of the things we're seeing. And then the other end of the IRA, which is something that we think about, although we have not invested in today, is that sort of reshoring of the supply chain that is bound to happen with all these incentives on the manufacturing side and metals mining end of the IRA. And so I think that there's going to be in my view this is the catalyst, right? There still needs to be innovation and advancements in technology, but I think the IRA made a lot of things that were either uneconomic or on the bubble of being economic, and I think that is going to be a massive, remobilization or redirection of capital into industries that, frankly, are pretty nascent or non-existent in the U.S. And having to scale those to the extent that people think that they're going to, scale over the next, 5 to 10 years. I mean, there's just going to be a ton of capital and, like I said, innovation required. So that's kind of what we're focused on, and we're looking to find the businesses that are sort of, again, in that ecosystem in and around all of this, and sort of helping companies or helping these projects become more efficient and more economical. So.
Great. George, what are your thoughts on the matter?
Yeah, maybe I'll split my comments in two sections. One is where we're seeing increased activity, and two is maybe some more macro comments on the repercussions of the IRA. But on the first one, I would say we've seen decidedly more activity on all things hydrogen and carbon capture. And it's a little bit of one of the two, given that, so much of the emerging hydrogen economy is around blue hydrogen production, right? So, natural gas-based hydrogen production, but with carbon capture on the back of it. But even green hydrogen itself, right, with some of the subsidies that are coming out through the IRA, you saw literally projects that were maybe limping along, right, in the first half of last year, really get supercharged over the last six months or so. I would say, though, even though it's in some ways accelerated the project and the financeability of it, for some of these projects to become a reality, there's other aspects of kind of the regulatory makeup that need to catch up to the IRA. And a great example is when you look at carbon capture, particularly the permitting of Class 6 wells, that whole mechanism of obtaining those permits is not quite there yet, right? So even though the credits for CO2 are there in the IRA, you need that permitting mechanism to be fully developed. And then, when that happens, I'd say something like carbon capture will go from very much right now, feeling like a private equity, in some cases, a growth equity play, to being, an infrastructure cost of capital play. In terms of the macro, I think we tend to focus a lot on, hey, what are the effects of the IRA domestically? But if you kind of take a step back, the IRA actually has global repercussions, right? And I think for the most part, they're very positive for the United States. It positions the U.S. more than ever as a long-term energy exporter. And when you think about other jurisdictions like Europe that are very climate conscious, that have existing regulations, it's really triggered some level of soul searching on, what is the right approach, right? Historically, Europe has been much more of a stick than a carrot, right? The U.S., the IRA is very much a carrot in terms of promoting additional investment in climate-focused infrastructure and whatnot through incentives, whereas Europe is all about, the punishment if you don't do certain things. So over time, if things remain unchanged, my expectation is it's actually going to bring a lot of foreign investment to the U.S. It's going to onshore a lot of the supply chain, to Matt's earlier points around where the credits fall, where the tax benefits fall. It really hits, a very broad segment of the overall supply chain. And so you'll probably see a lot more of the domestication of that, which will only help to improve our competitiveness in the global energy spectrum over time.
There's actually been, some news of the EU sort of saber rattling about, maybe some dispute resolution under the WTO related to the IRA. So, and we're seeing, just a disproportionate amount of foreign investment in this early wave for sure. Yeah, and
I'd say maybe our unique perspective on it at ARA is about 60% of our portfolio is U.S. based, 40% is European based. So we kind of see the effects of both sides, and a lot of our European companies are now seeing opportunities to expand their operations more quickly, right, in the U.S. than in Europe itself.
Perfect. Thanks, George. It's interesting, too, when we look at the IRA, because I think a lot of it is really hitting the energy transition and renewable markets, and that's kind of where the focus is. But, Brian, I'd love to get your thoughts on, because the reality is oil and gas isn't going anywhere. It's still a very important part of our energy because we are in the great United States of America, and we do expect energy to continue and electricity to continue, and it's vital to turn on when we flip the switch. So from your vantage point in the oil and gas industry, where are you seeing the IRA as some advantages or opportunities?
Yeah, I think the biggest thing is, and this word was used for the other businesses, but certainty, right? The certainty of the long-term business plan and the playing field that you're going to be under. And it has to do with the prioritization of federal lease sales, albeit at higher royalty rates. It's really important for our industry in terms of long-term investment, especially in the Deepwater Gulf of Mexico, where you're building large teams, you're spending a lot of money, that you're going to be able to backlog future drilling opportunities to replenish inventory and reserves and continuously be able to maintain and grow production for years to come, especially as people are focused on reducing emissions. Here in the U.S. in the Deepwater, we have the lowest carbon intensive barrel and the most highly regulated barrel probably. So we should want to be growing in that space. And so the IRA in the short term was great because it validated lease sale 257, gave us 2 additional lease sales in 2023. And then in the future, it's tied it to offshore wind sales, but we're still waiting to see that 5-year plan. So how many per year, and how that's going to look. But it's really important for us in the Deepwater because of the timing aspect. We could be going to a lease sale today for a project that we're not producing on for 6-7 years down the road. There's just a lot that goes into it. And with, current production declining and a lack of reinvestment over time, it's going to be important that we have these things and that certainty that people are going to want to continue to invest and grow their businesses in places like the Deepwater. And so it was nice to see some of that in the short term and some more certainty over the next 5 years with the tie to offshore wind sales. But I think we really want to see that 5-year plan and see more support and not a change in that policy, because it's tough when you're investing in a long-term project and things keep flip-flopping on where they're going to go. And so more certainty and less rhetoric going against the oil and gas space will be helpful.
All right, I might have a trick question for the panelists here. Does anybody believe that this act is going to reduce inflation? Long term, maybe you described why the long term could potentially, but I guess one of the questions that was a question I wasn't expecting an answer to, but ultimately, are any of you concerned about supply chain? We know that supply chain over the last several years has been just very much impacted within the United States and abroad. I think one of you had mentioned that before, but when you think about supply chain, you think about bringing all this into the country. What kind of concerns or what are we looking at from the supply chain? Who wants to take that one first? No, then I'm going to pick on somebody. George, what do you think about the supply chain?
Happy to offer my thoughts. I mean, I would say to your first question on the inflation piece, certainly in the long term, right? The thesis is you're positioning yourself to be an economic energy supplier, right? Relative to the rest of the world. So from a competitive standpoint, that's certainly going to help. I think the counter argument to that is the spur of investment, of near-term investment that something like the IRA will incent, right? That can create additional demand and potential supply chain disruptions and all things that contribute to higher costs. But I do think that, if you think of legislation as having a long-term effect, I mean, this is ensuring that America will have economical access to all sorts of energies in the future. So I would certainly believe that as counterintuitive as it is in the near term, the IRA will do its job as its title suggests. With respect to supply chain imbalances, just from our own experience developing and constructing projects, you're very much still seeing some of the cost impacts of a tighter supply chain. But I would say relative to where we were in 2021, it's already night and day. So my expectation is that's only going to continue to improve. And, as we plan out 23, 24 for the capital projects that we have, you're seeing quite a bit of relief already.
Perfect. Shane, do you have any thoughts on that?
Well, yeah. First thought, my immediate thought, maybe it's not the more sophisticated answer to your first question about will inflation be reduced is were jobs created with the Tax Cuts and Jobs Act. I don't think the names of these bills really necessarily correspond to the realities of what they produce. But setting that aside, I think I actually do think in terms of what power prices we're going to see on power purchaser agreements, whether those be with utilities or with corporates, I do think those are going down, in the medium term, near term, because of this bill. Whether the end consumers the retail consumers get to see that impact at the end of the value chain, I don't know, but I would expect that to follow suit eventually, because when you introduce PTC for solar energy, which we now have, you extend the PTC for wind energy, you got a whole lot of new generators bidding in at, able to bid in profitably for themselves at a negative electricity rate. So I think that is going to be a big driver long term now of some reductions in power prices. So I think that was my first thought. And then supply chain, I think we're all seeing the announcements of all the new manufacturing that's finally getting built. Not in reaction, I would point out, to tariffs, right? It's really domestic content incentives or domestic manufacturing incentives and domestic content tax credit adders that were included in the Inflation Reduction Act are why we see our clients looking to source domestically now. So we really are seeing firsthand from a lot of clients the desire to put shore up supply chain here domestically and to receive the benefits of those enhanced credits.
Okay. Blair, any thoughts?
I mean, I think we could argue about the whole idea about free trade and protectionism and whether that creates a higher price environment at some point in the future. But I think the point is, actually, I'll back up a second. Even if you look at the cost of a solar module today and what it would cost to produce in the United States, they think that with the sort of 10% break that the generators are going to get on the tax side, and then the 30% advanced manufacturing credit, the analysis that I have seen is that will bring it into parity in terms of cost as to what you could purchase a solar panel from China for, right? So if you think about the cost to the consumer of that product, it is incentivizing a lower cost over time, at least parity with China. But I think that the broader point, and this maybe goes more to supply chain than inflation, is that ultimately the goal is to bring the supply chain to the United States. I mean, I think everybody's probably seen those bar charts at all of the sort of metals and minerals and supply chain that comes out of China and how dominated it is by China. And so the focus by the United States government and the deliberate intention of this Inflation Reduction Act is to bring some of that supply chain and really de-risk it for the domestic energy space, in my mind, is really what the intent of that was, and whether that causes an inflationary environment because it ultimately is or is not as competitive as what you could source internationally. I think that is TBD. There's obviously a lot of work that needs to get done to actually reshore or onshore that supply chain, but ultimately, I think that was the government's intent.
Great. We've got a little bit of extra time. There's a great question that came in the chat, and I'm not sure who wants to take this. I know I'm going to call on if somebody doesn't jump in, but it gets to sustainability over time with energy needs. Energy isn't just a knee-jerk reaction to something, a quick, I can fix this whole thing in a year, 5 years, or even 10. It's a long-term game plan. And so after all these incentives start running out, are we going to be able to sustain this as a country and sustain, I guess, the decrease or sustainable energy pricing in the long term with this plan? Who'd like to take a first cut at that? Awkwardly. Okay. Who am I going to call first? Okay, I heard somebody. Go for it. Shane, was that you?
I'm happy to jump in. Yeah, I mean, it's a great question. I think the idea is at least, I guess, trying to think of a practical example here. Let's say PTC runs out for solar and wind. Do we keep building solar and wind at that point? I think the answer in that particular question is absolutely. I think if you fast forward out 5 or 10 years, it's going to be electricity generation. You'll have maybe some nat gas getting built still, but not a lot, and you're going to have a whole lot of much cheaper batteries combined, or whatever the energy storage solution is 5 to 10 years out, combined with very, very cheap due to ongoing cost economies of scale that are going to be realized over the coming years, that have been realized over the past 10 years and will continue to be. Cost curve is going to continue to come down. These are going to be marginal, no marginal cost fuel source electricity sources. So I think we will see a very sustainable solution that will come out of this on the other end, just with that example.
Any other thoughts?
Well, I would say in the very long term, I think there are some unanswered questions about high cost of extraction and, natural resources and different technologies to get that stuff to market, that could make this a longer term total fix than sort of people might be expecting. That's sort of the unknown that's sort of in the beyond the midterm and sort of in the, call it 2030s and beyond. Could be a sort of limit in fully transforming or fully transitioning, particularly transportation with the massive natural resource constraints there.
Yeah, I agree. It's definitely a long term, and for sure. The interesting thing too, in my mind, is that we've seen it play over and over again. It's going to be a lot about, and Matt, I'm going to kick this back to you to kind of close out this portion of it. But at the end of the day, these electrons have got to get into the grid, and there is a portion of the IRA that is investing in the grid management and grid infrastructure. I guess the real question is it enough? Seeing that we've got a lot of production potentially coming down the pipe, but is there enough to the grid management side? So knowing that there is, and I think the answer is we don't know. I mean, there's a lot of unknowns and variables. We don't even know what the best technology of energy is going to be in 20 years from now. There's a lot of new technology coming down the pipe. So I'm going to let you wrap it up and give your final thoughts on this, and then we're going to move on to some different activities. Matt, that was back to you.
Yeah, I mean, I think to your point about grid management, I mean, they certainly could have, had some more incentives for the grid, and there's a whole, obviously the queues, the interconnection queue system is broken and needs to be fixed to sort of fully facilitate this, but all that stuff is sort of left for, another day. I think, just in closing, I think again the IRA. It's right now. It's the time of the engineers. They're looking at sort of project level models, and they're sort of building out their costs based on current best information. And there are a lot of great technologies that are coming out of this stuff. But I think ultimately there's just a lot that needs to be done on the financing side, getting investors comfortable, getting lenders comfortable, particularly with the ability now to convert credits directly into cash, carbon capture, green hydrogen, all that stuff. You don't sort of need this. You may be getting a significant amount of the cash from credits directly in the form of direct pay credits, which are refundable tax credits now available for those technologies. So a lot of sort of finance modeling and a lot of, relationship building with lenders that understand tax credits and understand the risks, understand the tax issues. I think that's sort of something that people may be overlooking, and it's good to sort of, build that out when you're doing your development as well, and rather than just the sort of engineering capabilities of it.
Great. So we've been talking a lot of at the end of the day, where does the money come from? There's a lot of money that needs to be invested within the energy infrastructure in the United States and supply chain. So we've talked a lot about what's coming from the feds, but we know that's only a percentage of the needs. So I'm going to turn it over for a few minutes to talk with Jimmie Williams, who's going to start it, and really getting into some of the other activity, like how is the equity? Where's the money coming from a M&A type transaction. So Jimmie, why don't you take that away, and then we'll get everybody else's thoughts.
Okay. So I think overall on the, kind of if you look at the M&A markets and where the capital is coming from, I look at, probably it depends on kind of the, kind of the sector of energy that you're looking at. But, I think it's, the upstream oil and gas, as Brian mentioned before, has been a little bit capital starved over the past couple of years. Kind of the M&A activity, but still the M&A activity was, I think there was like $53 billion worth of transactions in the upstream oil and gas space last year, and that's kind of tending to continue to come from those traditional sources. But I think we're starting to see more of, a couple of people have mentioned it, more foreign investment in the U.S. in these areas, and that's both upstream, that's the renewable space, a number of different areas there. And then, and I think you've got examples, kind of on this call as well as where you've got traditional energy investors who are in funds that are now starting to focus on either they have a separate fund that's focused on kind of energy transition and the things around it, like the Lime Rock New Energy stuff, or you've got funds, that have a separate investment thesis. And I think as well, we're starting to see more and more of kind of what I'll say industry agnostic, kind of industrial private equity groups who are kind of developing investment theses around, kind of the service providers in the infrastructure buildup and various things within the transition space. So it's becoming, especially in the energy transition space, it doesn't seem like there's any shortage of people trying to invest money into the space. And then if you kind of go to more of the, I'll say the utility scale generation, you have kind of the traditional, investor owned, utilities who have the renewable groups who are investing in things. You've got the oil majors who are really kind of starting to put more money, into, renewables, whether it be like BP's purchase of, kind of RNG, company for like 4.1 billion. And you've got Chevron New Energies who's investing money in there. So you've got kind of capital coming from a number of different avenues. And then I think the foreign investment, infrastructure funds as well. So I think overall we're seeing, kind of a lot of activity and a lot of different players in the market space. But, certainly would like to get others' sense of that as well.
Yeah, I'm interested too, Brian. I'm interested in what you're seeing. I mean, I think you mentioned it a little bit before, but what you're seeing in your space, just because I think there's a lot of money going into a lot of places, but is it going everywhere in the energy space?
Yeah, so to Jimmie's point, 22 and even 21, we got to more normalized levels in terms of E&P M&A activity versus 2020, which was very low. I think during that time you saw public companies that were flush with maybe some more cash from higher commodity prices, but a lot of them just trying to gain scale and add tier one inventory life, all the while assets were trading at just much more depressed cash flow multiples. So these were cash flow accretive acquisitions. And you also had a bunch of private sellers that had been having a hard time realizing investments and returning cash to their investors. And so they were looking for opportunities to sell. I think in 2023, you're going to see kind of similar activity levels, especially publics, maybe the SMID caps looking to add to that tier one inventory life. I always see like 10 years, try to add past 10 years is like a key number. But also some of those similar dynamics are still there today, especially some of the publics have paid down more of their debt with the excess cash that they received. And also still kind of trading at those depressed multiples and privates still trying to get exits. I think one of the things that might hold things up a little bit or be a headwind is just that cash stock mix. And as Jimmie mentioned, maybe some foreign investors come in with more of a cash piece, but also you could see things like structured capital coming in to kind of bridge that gap for some of these public companies. As a seller in today's environment, I really think it's going to be important. Just three things that I would highlight. One, that they are going to have tier one inventory, so they're going to be attractive to a buyer, especially with robust economics in today's new cost environment. The second thing I would say is you're going to have a de-risk position with a good PDP base, given the lower reinvestment rate for these companies. They can't just buy a bunch of inventory and then expect to be able to, fund that where they're already funding their current drilling program. So they're going to want to have a good cash flow base to fund that development. But then the third thing that's more important this year more than ever is on the ESG side. It's really important if you're selling an asset that it's considered a clean asset and isn't going to be an environmental liability to a company that buys it. And so what are your emissions? What are you doing to reduce those emissions? to date, but also in the future, and has it been operating properly and in a clean fashion? And there's going to be just increased diligence and scrutiny on the ESG side in terms of being able to sell your asset.
Great. Thank you for that, Brian. George, what are your thoughts on the matter?
Yeah, I think I would say it certainly feels, and you know, granted, I most of what I'm seeing these days is on the decarbonization space, and for some of these more forward-looking opportunities, it's a very opportunity-rich environment, right? Notwithstanding the macro slowdown, the stakeholders that are pushing hydrogen projects forward or renewable fuel projects forward. I mean, these are all long-term stakeholders, right? In many cases, they're industrial incumbents. In other cases, they're companies that own IP that is going to be increasingly valuable over time. So, notwithstanding kind of the interest rate environment and the macro conditions, we're still seeing a very healthy kind of disposition, right, between buyers and sellers, or companies and sponsors. I would say that bigger transactions, right, that require leverage, so your classic buyout deal, call it north of $500 million. I mean, those are certainly much more challenging to do now, given the interest rate environment. I guess luckily, right, for a firm like ours and our area of focus, the more lower middle market transactions where you're really bringing growth capital in the form of infrastructure, private equity capital, those tend not to be very driven on debt, right? They're fairly unlevered for the most part. So because of that, the interest rate environment hasn't quite affected at least our ability to transact in those types of opportunities. Maybe a more general comment though, if you kind of think about the type of capital that will need to propel the decarbonization space, particularly away from the electron and more toward the molecule, which is where we're focused. I think you're starting to see a need for a different kind of investor. Not just someone who's savvy on the business side, but someone who's savvy on the business side and in executing on project development and construction, right? You need to have in-house resources that can get you comfortable with building that first commercial scale facility, right? So technology is de-risked, but there's a whole set of project management skill sets that you need to underwrite these types of transactions. And, that's really the direction where R has been heading is, as you look at the makeup of our firm, half of our firm is investment professionals, folks who do M&A in and out, but the other half is paired very closely with our investment professionals and their engineers, operators, project managers for helping us underwrite these transactions and ensure that we can actually follow through with them with the actual project execution post-closing. And over time, as more and more of these new technologies mature, I fully expect that, at least within private markets, you're going to see more of that pairing of highly technical with business savvy.
Great. Blair, what are your thoughts?
Yeah, I mean, I think the most consistent participant in the both sort of investment and M&A space, and I'm talking specifically about the energy transition, has been the strategics. even in this soft macro environment that we might find ourselves in this year, I think you're going to see, continued activity by the strategics because, they are focused on reorienting their business for the long term. And so, I think a good example is Shell buying Volta. I mean, Volta was a $2 billion public business a couple of years ago, and Shell bought it for, somewhere around 170 million. And I think that is because Shell has a long-term strategic play in the charging infrastructure market. And so I think you'll see more examples of those strategic acquisitions if the market stays soft and their views of valuations are low. And then I think, on the strategic side, we've also seen them moving aggressively to secure supply chains. So General Motors is a great example of a company that has, lofty forecasts for the amount of EVs that they're going to bring online in the next decade. And they recently made a $650 million equity investment in a lithium mine. It's a public company that they made a strategic investment in, which is not something that GM has done a lot of in the past. So I think we continue to see sort of strategic moves by the strategics in this market. On the private capital side, we have seen a cooling off. Venture capital has pulled back. They were pretty aggressive in the 2020, 2021 timeframe. We have seen them pull back a little bit. And we have seen more processes or deals that have not been successful at raising capital that probably would have gotten funded 18 months ago or 24 months ago. So we do see a cooling off, maybe more at the riskier end of companies trying to raise capital in this space. But I'm not sure I'd call that a trend because there has been and there will continue to be a lot of capital, private capital being raised in this space. And so maybe not a huge slowdown on the private capital side, but maybe just a bit more discretion about what gets funded in 2023.
Perfect. Shane, your thoughts?
Yeah, I think we've been impressed by the clients in the spaces that we work, how large platform, the number of large platforms that have been sold, both inclusive of the assets, the solar, the wind, generating assets, along with the platforms themselves, as well as the appetite from large buyers of those platforms. And I think there's still a couple of them coming this year. So it's pretty impressive, honestly, the ongoing appetite here and some of the consolidation happening with these renewables, super majors, if you want to call them that are sort of forming and looking to continue to acquire assets and market share here in the U.S. So we expect to see that continue this year.
So from what I'm hearing from everybody in the last, hour plus of this conversation is this is a very dynamic industry, and we've got a lot of movement, I think, in the industry. It's interesting to me because I know I heard at the beginning of the call, I think Matt is the one that said it, that we don't have a lot of, with the IRA, we don't have a lot out yet. But I'm going to turn it to you and see what you think about the M&A. And then do you see a lot happening from the legislative standpoint? Are we going to see a lot of activity in the form of, what are the grants going to say? What is the IRS going to say? What is everybody, Treasury going to say? Do we expect a lot of activity in the current year?
Yeah, I mean, so I think there's again, as many have mentioned, there's kind of a wait and see attitude to a lot of the sort of financing and sort of tax monetization this year until the regulations come out. I mean, you have completely new concepts, right, that there's no real precedent for example, the transferable credits. They also have provisions in the transferable credit provisions about partnerships. And so I will not get into the tax nerdiness of sort of what makes a partnership, but a partnership that just has tax credits in it. If you imagine someone forming a fund and buying a bunch of tax credits, which seems theoretically possible under the statute, that just makes like a partnership tax guy's mind explode. So I think there's going to be a lot of potential very interesting structures that come out of the regulations, where you could have all sorts of individuals and people buying tax credits and funds and buying and selling and sort of capturing margin or collecting a fee, finder's fees for putting these deals together. I think there's going to be a lot of financial activity there. Maybe Shane and folks similarly situated are starting to look at that stuff. But the other piece of it is direct pay, right? I mean, you have rural cooperatives who can maybe benefit or partner in different ways with taxable entities, and they would get a direct cash payment, which seems better for the developer to sort of not have a discount. The buyer just gets a direct cash payment. So I think there's a lot of structures involving partnerships, and I think there's going to be a lot of different people on both sides, buying and selling or acting as middlemen. That's going to come out of the transferability and direct pay stuff and how it interacts with sort of partnership tax concepts, which no one wants to hear about on this call. But and then the other thing is a substantial amount of value is tied up in wage and apprenticeship. As I mentioned, 80% of the credit, plus these bonus credits, which can mean the difference between doing the project and not. And there's just no guidance yet. And so, how do you sort of proceed in that environment? We're hopeful. We heard recently that the guidance in these areas is not imminent, which could mean anything from, next week to next year. So, we're hopeful, and I think that's going to really accelerate that innovation I was mentioning once we get those regulations.
Perfect. Well, we're getting close to the end of this webcast, so I'm going to give the presenters an opportunity, a couple minutes each, just to give some closing comments and thoughts about, as we round out and we're starting a brand new year. We anticipate this year is going to be one full of activity. I don't think any of us really know exactly when we get to December what that's exactly going to look like, but we do expect it to be very busy. So again, just give some closing remarks on where you see this industry going in the next year, or in closing remarks that you had on any of the conversation you had today. So I'm going to start with George. Why don't you give us your thoughts?
Yeah, these days it's hard to make predictions going into a year, because I feel like we're probably the third or fourth year in a row where at some point of the year there's some sort of black swan event. But setting that aside, I do think that standing here today, I strongly believe that the U.S. Energy economy is in a very, very strong position, right? I think there's an acknowledgement, as I mentioned earlier, that conventional sources of energy are extremely important, but there's also an acknowledgement, given climate change and energy security, that we need to truly accelerate, right, what that future of energy is. And I think across the industry, there's probably more consensus than there ever was on what the solution is. And there's finally agreement that it's dual. I think that all that overlaid with the boost that the IRA has given us, notwithstanding, some of the lack of clarity on some of the details, really sets the U.S. up really well for this year and years to come. So, as an investor, I'm a buyer.
Thanks, George. Blair, final thoughts?
Yeah, no, that was well put, George. Listen, I think where we sit, we see what is going to be, a multi-year trend and a massive mobilization of capital towards the energy transition space in the U.S., for multiple decades. I think because of all of the capital and businesses getting built in the space, the innovation and the advancements that are going to be made, there's going to be a lot of value to be created in the space that we're investing in. And, like I said at the outset, we are investing in the businesses that are sort of aiding the energy transition. And so, we are really excited about, all that the IRA and everything else that's happening in the U.S. is going to bring, just in terms of that sort of entrepreneurial spirit and innovation and ingenuity that's going to happen in this space. And, if we're fortunate enough to partner with those companies as they, help the U.S. meet its ambitions, that's something we're really excited about.
Great. Brian, your thoughts?
Yeah, I think, the energy needs of the world are only going to continue to grow. And, in the United States, we have a unique ability to be a leader in terms of oil and gas and doing it in a clean and environmentally friendly way. But also we have the ability with these other groups to grow our other ways of providing energy to the world. And so I think it's going to be important that we're investing across the value chain and across these different verticals, and continuing to invest in oil and gas as well now and into the future, because those needs will just continue to grow. And as E&P companies, it's our duty and responsibility to make ESG, part of our DNA, and to continue to do things better, and to, be reducing emissions or doing the best we can, but also other people need to understand, it's vital to our economy, vital to energy security, and going to be vital to the future of the U.S. and the rest of the world.
Brian, I like that. I'm going to steal that. Oh my gosh, I'm sorry, I've got some feedback. I'm going to steal is the ESG part of your DNA? I think that's a fabulous question to ask companies as they move forward. Jimmie, I'm going to give you some chance for your final thoughts as well.
Okay. No, I think as several others have said, I think we're really excited about the opportunities that are out there in the energy industry overall. I think it's from, kind of the energy transition to the traditional side of energy. I think it's going to be, kind of a great opportunity, while there's, hundreds of trillions that are going to have to be invested over the next 10 years. And I think the one thing that we, kind of have kind of danced around a bit is really that during that transition, there's going to be a lot of volatility. While ultimately power prices may come down, I think they're, kind of, you're going to start seeing more volatility on peaks and various things, because every new piece of generation that's coming online is intermittent by nature. So I think you're gonna have a lot of volatility in the power markets, and that provides, additional opportunity out there.
Perfect. I think getting that power to market too is going to have a lot of volatility. There's going to be a big challenge in that area as well. Shane, what are your closing thoughts?
Yeah, I agree completely with what Jimmie just said. Actually, yeah, the volatility is significant, and I think transmission isn't something we really hit on hard here, but it's the gating item for a lot of this electrification that we're talking about, and we're seeing it in markets right now. The transmission, there's already large transmission issues and huge delays in interconnection queues. And the build out of transmission really needs to accelerate for this all to kind of work. And so I think in the meantime, while that's sort of being built out, we will see some volatility, to Jimmie's point. And I think, it's sort of an all hands on deck and all the above type solution mentality, I think, to really make the most of the Inflation Reduction Act and all that it includes. And I will just say one other closing thought is, we certainly see it from our standpoint, but all of these new technologies, in addition to the not as new ones like solar and wind, are being incentivized through the tax code. And, there's only so much taxes that are paid here in the U.S. So, there is an interesting challenge there in terms of trying to make sure we're leveraging as much of the taxes that are being paid toward facilitating the clean energy transition here through all sorts of creative structuring solutions. But I think it will be an ongoing challenge to make sure that we're matching up credit needs with credit solutions on the buyer side. So that is one other thing I think we all need to be thinking through in our industry.
Great, thank you, Shane. I guess at the end of the day, it's all about balance at some point. So I think that's an very important thought. Matt, I'm going to let you wrap it up. Give us your closing thoughts on where we're at.
Yeah, we're in a good place, but you need a lot of fossil fuels to build this to create this massive change in the infrastructure of the country, and so that's not going anywhere, which is just fine. I think, to Brian's point, I think ESG and other social pressures will be there to sort of make sure that they're doing the best they can and sort of creating the cleanest product that's possible. I mean, long term, how is this going to work when? Is it just going to be transfer payments to the less developed countries to get them on board? How's that all going to work globally? How do we tell them to hamstring themselves to sort of achieve whatever global climate temperature readout we want? So I think there's a lot of big picture issues there, but we're certainly in this country what we can control. I really like where we're headed at the moment.
Yeah. Completely agree. Well, I want to put a huge thank you to all of our presenters. Thank you for everybody that attended today's session. We will have more as we continue onto the year. Obviously, I think the biggest thing is don't blink. There's a lot of change and a lot going on in the energy industry, and it's all very exciting and for a very good cause. So thank you once again to everybody. And I'm going to turn it over to Amy to give us her closing remarks.
All right. Yes, thank you to all of you for a really great discussion today. And to our audience, thank you for being engaged and submitting your questions to help guide today's conversation. If we didn't have time to answer yours, we will do our best to follow up with you. And Moss Adams does have quite a few resources available on our website, some of which are linked in your console for your convenience, as well in the slides that you can download from the slide deck and handouts window. So definitely check those out if you haven't done so already. And finally, here's a link to an online survey for today's presentation. And thank you for joining our webcast. Take care, everyone.
Thank you.